Hello and welcome back viewers, I'm Nifty and you're watching the Savera. If you've ever invested in SIPs, you know the emotional roller coaster. One day you feel like Warren Buffett, the next you question if your Chai Tapri uncle gives better financial advice. But here's the real deal. Should you pause your SIPs in this volatile market, or is that the worst mistake you could make? Let's break it down with data, history, and yes, maybe even a little common sense. Market volatility has left many investors questioning whether to continue their systematic investment plans or SIPs in mutual funds. Recent reports show a 26% drop in equity mutual fund net flows in February 2025, reflecting investor hesitation. Tonight, we analyze the data and expert insights to assess whether staying the course is the right move for long-term wealth creation. Why uncertainty tempts investors to press the pause button on SIPs. Short-term losses and economic uncertainty can spook investors. A recent post from January 2025 highlighted that after 21 months, SIPs in the Nifty 500 showed negative absolute returns. This might push some to consider stopping SIPs, fearing further erosion of capital. Now hold on, no rush here, let's check what history books of investing have taught us so far. Despite short-term declines, historical returns of SIPs in Indian mutual funds consistently demonstrate resilience and growth. Let's break this down. Long-term recovery outweighs short-term dips. A March 2025 post from Motilal Oswal noted that during the 2008 crisis, SIPs held for 5+ years delivered a compound annual growth rate of over 12%. After the 2020 crash, 85% of SIPs held for 3+ years turned profitable by 2023. Another study of the Nifty Small Cap 250 TRI from 2018 to 2025 showed that its worst 7-year SIP return was minus 7.3%, yet it rebounded to plus 14.8% in the 8th year. Next, compounding works over decades. This bar chart visually demonstrates the impact of stopping versus continuing SIPs during market downturns, specifically in 2008 and 2020 periods when the markets went down. The key takeaway here is crystal clear. Investors who continued their SIPs through volatile periods saw significantly higher investment values than those who paused their investments out of fear. Next, rupee cost averaging mitigates volatility. SIP works best in volatile markets by accumulating more units during downturns. Let's look at an example. During the 2008-2009 crash, Nifty 50 fell nearly 60%, but investors who continued SIPs through the dip benefited from the subsequent 80%+ recovery by 2010. Now, if you look at insights specifying them categorically. Large cap funds like Franklin India Blue Chip or HDFC Top 200 have delivered 15 to 18% CAGR over 15 years via SIPs. Mid and small cap funds have often exceeded 20% CAGR, and Nippon India Small Cap Fund delivered 22% since 1995. Now coming down to the million-rupee question, quite literally. Should you continue SIPs? Our advice? Yes, but smartly. Think long-term. If your goal is 5+ years away, history favors staying invested. The Nifty 50's 26-year average SIP return is 12 to 14% CAGR even through crashes. Diversify wisely. Spread investments across equity, debt, and hybrid funds to reduce risk. Take a look at this pie chart, for example. No panic buttons. Data from 2008 and 2020 shows that stopping SIPs means missing out on major rebounds in just 3 to 5 years. Review, don't exit. If a fund underperforms for 3 to 5 years, switch, don't stop. Track performance against benchmarks like Nifty 50 or Sensex. In short, let compounding do its magic. Now the caveats to consider. If you have short-term needs, equity SIPs may be risky for goals under 1 to 2 years. Opt for debt or liquid funds instead. Fund quality matters. Top funds outperform by 5 to 10% annually. Research before investing. That's the best advice. Market extremes. India's 6 to 7% GDP growth supports long-term investing, making stagnation unlikely. So the key takeaway here, choose wisely and stay informed. Again, For Indian investors, historical data underscores patience. SIPs in equity mutual funds have a proven track record of delivering 12 to 20% of CAGR over 10 plus years, even through market crashes. Market uncertainty is temporary, but compounding is permanent. Our final advice here: continue SIPs if your investment horizon is long term. Tweak your portfolio for balance, resist the urge to time the market. So that's all for now. You stay invested and we'll make sure to keep tracking the numbers for you. Until then, stay tuned to The Savera. Like, share and subscribe to our social media handles, and don't forget to download the Savera app for real-time news.